Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark checks in on volatile equity markets. Zeal LLC CEO Adam Hamilton explains how low interest rates have cost you a bundle. American Manganese President Larry Reaugh would like the Uptick rule returned to Canada. We'll talk to Ross Clark right after this.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always a pleasure to be with you, Jim.
If you were profiling the equity market charts this week, it would kind of resemble the profile of the Rocky Mountains, wouldn't it?
Pretty much so, and lots of hills, lots of valleys, but pretty sharp rises and falls along the way. Here we are. We've got 9 or 10 weeks since that February bottom, middle of February. Market had just an exponential move to the upside week after week until the middle of March, and now we've got stuck into very tight trading ranges. But we're going from the top end to the bottom of the ranges in a matter of 72 hours, over and over again. This week, the VIX, which is the measurement of volatility, had 7% swings absolutely every day of the week. And the net result on the week is that the market is basically where it's just a shade below where it finished off the previous week, and we're where we were back on March the 18th. So, you go from these phases of strong trends into consolidations, and the stronger the trend that you've had, the more of a reaction or consolidation phase that you tend to have afterwards. So, I'm still of the mindset here that the bulk of the seasonal run from in the presidential election year was to have been into the late March, early April window, so we're in there now. And, we would hope that there would be a pretty decent pullback at some point during April. And if we look at all election years, not just the ones with an incumbent president, the likelihood of finding a good buying point in the mid to third week of April has been pretty good over the years, with then the next high being out into July, mid-August. So look for, say, an opportunity for those who didn't get on board back in February to maybe have an opportunity here in the next few weeks.
7% swings under the recent rules on the Chinese stock exchange, that would have stopped trading in Shanghai.
Well, okay, that's a 7% swing in the VIX itself, which is not what we're talking. You're not looking at a 7% swing in the market, but it's just that, that's the volatility index itself is moving that much in anticipation of us coming out of the trading range, which we have not been doing. So if this was China, it would be a little different ball game, but we're talking about North America.
And, of course, in China, if they don't like the way you trade, somehow you disappear. You haven't been arrested. You just don't exist anymore.
I'll leave that comment to you, Jim.
We've been told that gold stocks right now may make a bit of a correction, but it's still a very positive outlook if you look at it year to year.
Well, the stocks have been holding up exceptionally well, and they've been outperforming bullion, as you would hope, coming off a bottom. But now in this consolidation phase where bullion is stuck at $1,240, and it's been as low as $1,205 and as high as $1,280 in the last 5 weeks. But if we take a look at the GDX, GDXJ, which is the senior and junior miners in the precious metals, you take a look at the Huey, they all had an exceptionally good week this week. So the the larger institutional players are definitely putting gold into their portfolios, and it doesn't take much from them as a percentage of their total assets to move that complex around. So to say this was an exceptionally good week for those. I'm still fairly antsy about the bullion price itself because the commitment of traders numbers continue this week to show marginal increases once again in the net short positions of the commercials and a small increase in the long positions of the non-commercials. Those are the speculators. So I think it's pretty important that gold hold that 1210 level, which we view as the support in there right now. On the upside, if it starts to move through 1280, then I guess the momentum will trigger a pretty decent rise from there. But I'm pretty cautious right now.
Ross, if somebody wanted to get more information from you, how can they get a hold of you?
Well, the email address here is ross.clark@cibc.ca, and I will have a piece regarding the presidential election year and the seasonality that offers itself opportunities in the month of April.
Ross, thanks for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up next, Adam Hamilton on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Adam Hamilton, CEO of ZealLLC.com. He's speaking to us from Colorado. Welcome to This Week in Money, Adam.
Thanks so much for having me, Jim. Great to be here.
What has been your impression of the equity market so far this year?
Oh my gosh, crazy. Just immensely volatile. You know, being in the States, I watch the U.S. markets, and I prefer the S&P 500 for a variety of reasons. You know, the Dow 30 is kind of the popular media metric of the markets, but it's an old arithmetic average. It's just 30 companies, and so the S&P 500 is 500 companies, market cap weighted. And it's just been crazy. You know, this thing fell, I don't know how much it was down, like 12% between early January, between the start of the quarter, first quarter, and mid-February. Then it rallied 13% from there. It was one of the biggest quarterly comebacks in market history. Apparently there's been 2 or 3 other ones of that magnitude where the markets fell 10% plus intra-quarter, then rallied enough to make for a positive quarter. And so they're extremely rare events. But the whole thing reeks of a bear market rally, Jim. And so, you know, bear market rallies are really fast. They ignite via short covering, which is what happened in this stock market rally. They're violent. They're exciting. They bleed away all the fear that is evident at the bottom before the bear market rally. And there's this fear indicator, the VIX, your listeners are familiar with, VIX, and you know that was getting higher in mid-February. Now it's down to like just hyper complacent levels, like the 13s recently this week. And so the market's really complacent now. I think the bear market rally is about run its course. Back to those inter-quarter rebounds. If you use the Dow 30 data and you go back to 1900, apparently there's 26 quarters where the markets fell 10% within one quarter and then rebounded 8% plus before that quarter ended. And 24 of those 26 quarters since 1900 were in secular bear markets. I mean, this is just textbook telltale bear market behavior in the stock markets.
What does this tell investors?
I think it tells investors that the secular trends are shifting. You know, we've had an amazing bull market, you know, lots of it because of central bank money printing since March 2009. And it's run its course. You know, bulls and bears are cyclical. You have these cycles that run all throughout market history. You have a bull market followed by a bear market followed by a bull market. It's just this giant sine wave that meanders through history. And bull markets don't last forever. Eventually they get too old. The stocks get too overvalued. Here in the United States, the S&P 500 stocks, the most elite companies in America, they were trading near 28 times earnings, which is a bubble valuation level historically based on trailing 12-month GAAP, generally accepted accounting principles earnings. Last year, they're up around 26 times right now, still after this bear market rally. I mean, stocks are too expensive. This rally's lasted too long. There was too much easy money from central banks that got injected into this bull market. And it's time for a bear. It's time for a reckoning in stock markets. You know, bears tend to cut stock markets in half over a year or two. They're nothing to fear. I mean, it's just normal market cycles. It's like winter coming after summer. But if you're unprepared for it, you know, it really hurt to take a 50% loss in your stock holdings if you're nearing retirement age because you weren't ready for just a normal market cyclical event.
Is this going to be very significant when you have so many baby boomers retired or about to retire?
Oh, it's going to be very significant. You know, for the people nearing retirement age, they just can't afford to take a 50% loss in their holdings. You know, I don't know how, say you have 3 or 4 or 5 years left before you retire, or even less, you know, there's not enough time for the markets to recover in most situations. And plus all that time is lost. If you ride a bear market down, you could have been making money somewhere else, like gold, for instance, which tends to rally or move counter to stock markets, so it rallies when stock markets are in bear market mode. And so the people nearing retirement age face huge, huge risks here. Another thing that's really, really frustrating to me is that, you know, Wall Street has a vested interest in keep people fully invested in stocks no matter what. And the reason is because Wall Street usually takes a % of assets management fee. You know, you have your portfolio, they take 1 or 2% a year or whatever to give you advice, to manage it, to move your money around. So they really don't care, you know, what's going to happen in the markets. They say they do, but all they want is to have the most assets under management to maximize their fees. And so their incentive is to keep you invested, not to sell you out. If they tell you to sell to get into cash for a bear market, you know, they're not going to make their fee probably. And so their incentives are just to downplay the risks all the way down. And that's what they'll do. That's what they did in between 2007 and 2009, you know, and between 2000 and 2002. I mean, during bear markets, Wall Street stays bullish till almost the very end, and people who listen to that mainstream financial thought get trapped in those bear markets and lose a tremendous amount of actual money and also opportunity costs of not being in things that rally during bear markets.
Did people make back the money that they lost in the last recession?
Did they make back their money?
Yes.
Yeah, the market's recovered. If you look at the S&P 500, sure, you know, but what was that time gap? Was it like 6 or 7 years between tops? So if you're in it, if you buy in towards the top and you get stuck in a bear market, and then you have to wait for the next bull market to bring stocks back up to those levels, I mean, that's like 5, 6, 7 years of opportunity costs. And you could have been in something that rallied during those 5, 6, 7 years, like gold, for instance. And maybe the markets didn't really recover. If you look at the S&P 500 and adjust for U.S. Consumer Price Index inflation, Jim, you know, the stock markets are essentially at where they were in March 2000 at the secular bull market peak. And so we've been in a secular bear since early 2000, and the stock markets have just ground sideways in real inflation-adjusted terms. So even at the tops, stock investors have done terribly since 2000. And history has shown that. There's these great third-of-a-century cycles I call long valuation waves that move through the stock markets. And the first half of these is a 17-year secular bull. The second half is a 17-year secular bear. And during the 17 secular bear, stocks are generally a bad place to be. There's cyclical bears within that secular bear that cut stocks in half. Then there's cyclical bulls within that secular bear that double stocks again. So if you can ride the cyclical bulls, you can do quite well. But for buy and hold investors, you know, it just ends up being a total wash for 17 years. And, you know, you think about the average person's lifespan and productive years, maybe 40 years of work before they retire. You can't afford to have your money just move sideways and not appreciate for 17 years. I mean, that's half your useful investing life for most people. Plus,
interest rates paid by the banks, if they do pay any interest rates at all, are so low. Where do you put your money safely to make money?
Yeah, it's just a travesty. I just looked at that last week, actually. I was writing our monthly newsletter and looking at, I was trying to figure out what the Fed's zero interest rate policy did to savers over the past 7 years. And so I dug up the Federal Reserve data on savings in America and looked at, you know, how much more would savers have made if interest rates were 2% higher than they actually were? You know, say ZIRP cut interest rates by 2% from what they really would have been otherwise. You know, then it cost American savers like $875 billion. At 3%, it jumps to, you know, $1325 billion. At 4%, almost $1.8 trillion. So the cost to savers has been absolutely tremendous because of these zero rates the central banks are doing. You know, the markets were designed to have mutually beneficial transactions between everybody. So someone works hard and they live on less than they earn. They accumulate surplus capital. They should be able to earn a fair return for lending that surplus capital to someone who needs it. And historically, that rate's been around 7%. You know, 7% is a fair rate to pay if you're borrowing. 7% is a fair yield to earn if you're lending. But the central banks kind of tilted the balance, or radically tilted the balance away from savers towards debtors, totally subsidizing debtors at the expense of savers. And you know, I've always liked gold. I'm a gold guy. Gold's a great place to be in secular stock bears because it rallies when stocks are moving sideways or lower. You know, in the zero interest rate world, the fact that gold doesn't earn a yield is irrelevant. People call it a sterile asset, but so too are most technology companies that don't pay dividends. You know, there's a lot of sterile assets that are incredible for appreciation potential. Personally, I'd much rather own gold. You know, the central banks around the world are printing money like crazy. You know, in the U.S., the broad money supply grows like 7% a year, you know, just forever. And all that new paper money is coming into existence all over the world, or electronic money, and the gold supply can only rise like 1% a year or less worldwide. And so gold gets more and more valuable over time as there's more paper money, fiat currencies, electronic money to chase it. I'd much rather be in gold than cash in this environment.
Somebody just a year or two ago called gold pet rocks. and I thought, what a silly thing to say, because first of all, a pet rock's $9. and you never expected it to increase in value. But gold, of course, was flat or was pretty low. But Goldman Sachs a year ago predicted gold would go down to $750 an ounce American. Of course, it never did. Why would they say that?
That pet rock thing was a Wall Street Journal article, I think. That was really interesting. You know, sentiment is what drives the markets over the short term, you know, greed and fear. And after a long cycle, after a long period of price declines, everyone extrapolates that trend into infinity. The same is true after a long period of price increases. And so late last year, you had the stock markets that rallied since 2009 practically nonstop, especially since 2013 when the Fed's third quantitative easing campaign kicked in. Then you had gold, which had fallen, you know, essentially since 2011. And people were just extrapolating those trends. So everybody was super bullish on stocks late last year, and they're super bearish on gold late last year. And, you know, it's kind of hard. I'm in the newsletter business. I've been in the newsletter business for 16 years now. And, you know, investors out there, they want to have their ears tickled. They want to hear that something that's gone up forever is going to keep going up forever. They want to hear that something that's gone down forever is going to keep falling forever. So you have a much bigger audience if you play into what people expect based on their own sentiment. So there's a huge demand for things that justify the status quo after a long trend in the markets. So people were just extremely bearish on gold when they should have been bullish late last year, and they're extremely bullish on stocks when they should have been bearish. And so I think they're just sentiment, Jim. You know, articles come to the forefront when they get hits, when they get views, when they sell newspapers, whatever. And so the articles that match popular sentiment are the ones that are the most popular. And then contrarians like me, you know, we tend to be ignored until well after the turn happens, because no one wants to read about market turns before they happen. Unfortunately, those reversals are kind of hard for people to predict. They want to have their views justified, and they're bullish when things have rallied for a long time. They're bearish when things have fallen for a long time, and that's just the way the human mind and psyche works, unfortunately.
You're listening to This Week in Money. I'm Jim Goddard. We're speaking with Zeal LLC CEO Adam Hamilton. Yes, we all know that the saying, buy low, sell high, yet it seems to me in reality people do exactly the opposite.
They do exactly the opposite. It's so frustrating trying to help investors thrive in these markets, you know, through cycles. The time they want to look into buying is when it feels the worst. Like when I make trades, sometimes I feel almost nauseous. You know, I'll buy a gold stock at a 10-year low, and I just, you know, I hate doing it. It's not fun. It's not exciting. It feels terrible. You know, what if it goes down another 20% and hits my stop right away? But buying low, the only way to buy low is to buy things that are hated, loathed, despised. You have to buy into markets that no one likes, because if there's no capital, and that's the only time prices are low. And investors have to realize that everything's forever cyclical. So things that are out of favor can't be out of favor forever, and things that are in favor can't be in favor forever. So therefore, it makes sense to buy low on things that are out of favor and sell high on things that are in favor. And that's how you can make immense amounts of money in the stock markets. That's what Warren Buffett has done for a lot of his career, buying low. That's what the great real estate investors have done, buy low. It's so hard, though, to go against the grain, to fight the herd. You know, you go to a cocktail party, everybody's excited about tech stocks, and you're like, hey, I got this great gold stock. You know, you don't even want to say anything because you'll just get ridiculed for it. Yet the gold stock has potential to go up 10 times in the next 3 years, and the tech stock has potential to go up, you know, maybe 50% if you're lucky in that same time period. But people hate buying low, and it's something you have to overcome by studying market cycles and spending lots of time immersed in markets to understand that you got to fight your own emotions. If you feel something, if you're excited about something, it's probably the wrong time to buy. If you're depressed, it's probably a great time to buy. It's a hard thing to learn, but it takes time on task to kind of internalize all that.
There must be a lot of emotions right now about the crude oil industry.
Oh my gosh, I have so many friends in the oil industry, and I read so much about it. There are, you know, oil's been so tough. It's been another one of these commodity bear markets artificially extended by this crazy central bank, you know, manipulation of markets, gross distortions through the extreme money printing and quantitative easing and zero interest rate and negative interest rate policies. You know, I'm kind of hesitant in oil right now, though. You know, it's super low without a doubt. But you look at global supplies, and there's still this huge glut of above-ground supply. And at the end of last year, the global supplies in storage in tanks and tankers was running like 1 billion barrels above the average of the past 5 years. And just to get through that supply glut, if you have a 1 million barrel per day deficit, it takes something like 2.7 years to go through the extra billion barrels, that's sitting out there. And so even if production falls, which it needs to do to balance the current supply-demand situation, to make the production surplus go to production deficit, you need to run this production deficit for a long time, unless it's huge, to get through this giant surplus of above-ground oil. And so I'm not very bullish on oil right now. I really want to be. These oil stocks are so beaten down. These companies have just experienced pain it's just like apocalyptic levels of pain in this industry. But this oil situation with all this oil sitting in storage, I'm really cautious on it right now until that's rectified.
Do you think central bankers realize the damage they do to the economy by not letting natural cycles happen?
No, I don't. I think they've totally drank the Keynesian Kool-Aid, Jim. I think they believe to the bottom of their heart that they're helping, that the lower interest rates, generate employment. It's hard to imagine them being so, evil or Machiavellian that they would know how destructive their policies are and still do them anyway. So I think these guys just really believe what's taught in most universities, that, government spending helps, that government's wise and benevolent, that markets can be managed, that free markets shouldn't be left on their own, that the business cycles are bad. And, so I have to follow the central bankers a lot, unfortunately, because they move markets so much, and I really think they sincerely believe that they're helping. But obviously, history would argue just the opposite. They're just destroying all kinds of markets and intensifying cycles and delaying reckonings that are going to be much worse because of their meddling. But I don't think they have malicious intent.
Does Janet Yellen know if she burps, the entire world recoils?
I wonder about that. Last week she had a big speech for the Economic Club in New York, and she was super dovish after the regional Fed presidents for the 12 Fed districts. Like 5 of those 12 people had been really hawkish after the FOMC meeting in March. And some of the stuff she says, it seems like she really has a really remedial or almost non-existent knowledge of the markets, how markets work, and how her words are going to be interpreted. I don't know if she wants to levitate stock markets, but every time she talks, that's what ends up happening because of the way she speaks. And as I watch these central bankers, I feel a lot of them don't understand stock market cycles, and they get so immersed in their economic data, their models, that they just don't think about or can't comprehend the real-world impact of their policies.
In Canada, the Trudeau government plans to run $30 billion deficits for the next 5 years, and the parliamentary budget watchdog says it won't create the number of jobs that the government predicted. It won't make the economy grow as much as it predicted. Then why did they do it?
I don't know. I mean, is it crony government? Are they trying to enrich friends who run construction firms? A lot of the government spending goes into infrastructure, of course. That's kind of a favorite thing of the liberals in the U.S. Let's build roads, let's build bridges, and it sounds good, but it really doesn't create that many jobs. I agree with you, and I don't know why they do it, Jim. It's really frustrating as a fiscal conservative to see that overspending and to see the deficits grow, the debt grow bigger and bigger. And it doesn't seem to create that many jobs. In the U.S., we've had one of the worst recoveries ever since 2009 in terms of jobs created. And the vast majority of jobs have been low or minimum wage jobs in the service industries like food service, hospitality and leisure. Just flipping hamburgers, slinging burritos. I mean, those are great entry-level jobs, but you can't support a family on them. And I think that's one of the reasons why the electorate in America, at least, is so mad, because the government keeps telling us everything is great, everything is awesome, our policies are working, they're creating jobs, but people can't support their families anymore, and there's something really wrong under the surface here.
Well, in Alberta, where they've had massive layoffs due to the downturn in the oil industry, McDonald's just announced that they're going to be creating 1,900 new jobs in Alberta. Like, that's going to turn things around.
Yeah, you go from $100K plus oil job, which is an amazing job, to $20,000, $25,000 working at McDonald's if you're lucky. For minimum wage, it's going to be less, I'm sure, and he doesn't do anything. And I wonder if those service jobs are going to be sustainable. Eventually there'll come a point, if incomes are so low or so depressed, that people won't even be able to go out and eat a McDonald's as much as they would like to. And just low wage jobs just aren't. You can't support a family on them. They're not. They're supposed to be entry level jobs for like kids, not jobs for adults with experience. And it's really sad.
And the negative interest rate experiment in Japan and Europe hasn't really worked out, has it?
No, Japan's a nightmare. And the Kuroda, the Bank of Japan under Kuroda, the governor, At their very first meeting after they went NERP back in late January, they already struck that line from their statement that said we're ready to push rates lower if necessary. Although earlier this week, Kuroda told Parliament over there that he would be willing to go more negative if necessary. But the Japanese people hate it. Japan had to cancel some government debt auctions to Japanese citizens because who wants to pay the government for the privilege of lending it money? I mean, it's nonsense. It's crazy. Europe, all the stimulus by the European Central Bank and Mario Draghi, he just unleashed another big bazooka of additional quantitative easing back in early March and cut all three rates, cut the main rate even more into negative territory. But things are terrible over there. Jobs aren't there. Inflation is running like 0.9% year over year on a core basis. If you strip out food and energy, none of these policies are working yet. All central banks can do is print money or talk about printing money. The great Franklin Sanders, an American newsletter writer, calls it liquidity and blarney. I mean, that's all central banks can do: print money or talk about printing money. That's their only strategy. When you're a hammer, everything looks like a nail. So that's all they ever do is expand the money supplies, and they think it's going to fix things, but it just makes things worse over time because natural market forces can't react and get rid of the dead wood. Some companies need to go bankrupt; they're not effective. Some governments need to go bankrupt because they're just inefficient. But when central banks prop everything up, nothing changes, nothing gets better. It's just horrible.
Should the big banks in the U.S. been allowed to fail back in 2008?
Without a doubt, absolutely. Everything should be allowed to fail if it's been run so aggressively that it can't survive a normal business cycle downturn. Everything should have been allowed to fail, whether it was local governments, banks. Would have been painful, but the recession would have been sharp, hard, fast, and we would have had a real, true boom afterwards, just like in the past, rather than this artificial, jobless recovery for the past 7 years, and when nothing really has really been accomplished. It's all just smoke and mirrors, artificial or excessive money has inflated the stock markets artificially. Nothing has been accomplished. Nothing really has happened. Wages aren't up, and so it's just all fake now. And if we would have allowed things to go bankrupt, it wouldn't be. It'd be real recovery.
Adam, can you tell us how people can learn more about ZealLLC.com?
Yeah, stop by ZealLLC.com. We publish 2 newsletters. One's published monthly for investors. One's published weekly for speculators. Cost is just $10 an issue. We're just trying to share knowledge with investors out there, help people learn to cultivate a studied contrarian perspective to help them thrive in the markets by actually buying low, contrary to what Wall Street's trying to do.
Adam, thank you very much for being on This Week in Money.
Thanks so much, Jim. Really appreciate your time.
My guest has been Adam Hamilton, CEO of ZealLLC.com in Colorado. Coming up, American Manganese President and CEO Larry Reaugh on This Week in Money.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Larry Reaugh, President and CEO of American Manganese Incorporated. His website, AmericanManganeseInc.com. He's speaking to us from Vancouver. Welcome back to This Week in Money, Larry.
Well, I'm glad to be talking to you again, Jim.
The Canadian stock exchanges no longer have an uptick rule in place. Can you explain what the uptick rule is and how it works?
The uptick rule was a solution that was developed back right after the Great Depression in the mid to late 30s that said you couldn't sell a stock you didn't own, which meant that you had to borrow the stock, number one. Number two, you couldn't sell it unless it was an uptick, and which means the price upticked. To give you a simple example, if it was $1 stock, you couldn't sell it till it was $1.01, and that corrected the market, brought confidence back into the market, and then we went on for the next 80 years with that.
Did the uptick rule basically ban shorting?
It didn't ban shorting, but it made it more of a bet. Now, without an uptick rule, it's a total opposite of that.
Who benefits from an uptick rule being in place versus who benefits from it being removed?
Well, let's take a look at who benefits. Well, first of all, the entire country benefits because the economy is a lot stronger because investors are putting money into projects and companies, and they invest in these things expecting they will make money. They invest over a period of time so that if you bought a company Canadian Barrack at the early stages and you hung on to it, you'd have become very wealthy. It didn't matter if you bought Microsoft. If you bought that at the early stages, you could become wealthy too. So it benefits the investor, and it benefits the company, it benefits the country, and it benefits, of course, being the country, the economy.
If the Uptick rule came back, would it be good for the Canadian economy?
Well, let me answer the other part of the question, and what's that do for the predators? The predators basically no longer make a bet on whether a stock is going to go down by shorting it. It's more that they have the opportunity to manipulate the direction of the stock. And that benefits a small group of people, usually traders, brokers, day traders, funds, people that have the capabilities and the knowledge to realize that constant selling on a stock will drive it down and guarantee profits.
What does that do to the average investor?
Well, it destroys the average investor. And, as you've seen on the TSX Venture Exchange, the investors have lost 99% of their money. And what's that do for the economy? Well, some of these companies employed anywhere from 5 to 100 people. Now they're lucky if they employ any to maybe the top employment companies would be about 20 or 30, and I'm talking about the incubator companies.
Are these rules just too onerous for real investment?
That's where people go to speculate now. They go to the casino because with no uptick rule in Canada, you have better odds of playing a rigged game at the casino than you do buying a stock on the various exchanges.
The TSX Venture stocks now trade on 13 different trading platforms. We hear that reinstating the uptick rule over 13 platforms is very difficult to impossible. Is there a way to reinstate the uptick rule with relative ease, specifically for TSX Venture listed stocks? And what percentage of trades go through the Venture Exchange versus the other platforms?
I'll answer the first part, the last part first, and that is it's probably greater than 90% of the stocks trade on the Venture Exchange. And the various platforms, from my understanding, is that it would be very difficult, although I'm not seeing the mechanics of that, to reinstate the uptick rule. But if the TSX Venture Exchange reinstated the uptick rule, then you would have a lot better chance for the incubator companies to finance projects and to develop into the major companies that we have around the world today. It's basically would be the platform, and I think everybody else would follow. Each platform would say, "Hey, we want our fair share. We should also kick the uptick, reinstate the uptick rule." I mean.
Of course, we've heard from the exchange that it's impossible to do it because of these 13 platforms. Could they do it with ease?
Well, that's what they say. It's not necessarily the exchange. It's comes from various sources like Reaugh, and that it would be very difficult to do that. I know that the U.S. reinstated their partial rule, and they have various platforms. It didn't seem to be a problem. But if it is a problem, again, I reiterate that that if the TSX Venture Exchange was to reinstate the uptick rule, I think that would be a huge benefit for the investors, the companies, and it would, the alternate platforms are basically platforms where these stocks are, without an uptick rule, are being manipulated today.
It seems to me there are so many apps that you can get to do various things. So what if there's 13 platforms or 1,300? Can we not come up with computer programs to deal with that?
Well, you would think so. I mean, when we got rid of the uptick rule, it didn't seem to be a problem. There were various platforms at that time. And, like I say, the U.S. reinstated in 2010 a partial uptick rule where you can't short down more than 10% a day. But you only have to look at the statistics to realize that investors have just withdrawn from the market, Jim. they're not there anymore. They see it as a guaranteed way to lose money. Mind you, there could be a bull market coming up, and that would push the short people to the side if you have a good project and a good story. But some of the companies that have good projects that are waiting for buoyancy in the price or something like that of the commodity that they have, they're going to still sit there and malinger. So, yes, we could have a bull market in certain stocks, and then the rest of the market is not going to rise like it used to, like, the tide that rises all ships. When the bull market comes, it won't necessarily raise all ships.
Do you think it's more important to have multiple platforms or an uptick rule, because it looks like we can't have both?
Well, alternate platforms is a democracy, right? And, you can't just say, hey, you can't have an exchange. You're going to give it a monopoly to one exchange. But it's more important to the economy of Canada, to the health of the companies, to the health of the bank accounts of the investors, to reinstate the uptick rule.
Have you talked to anybody amongst either the regulators or the governments about bringing it back?
Well, I know that various people have. I haven't directly talked to any of them. I know that, that the bureaucracy is where you end up in those discussions most of the time. And it usually stops there. But, I think the interest now, the last white paper I saw on a survey that was done by the TSX Venture Exchange, when the question was asked, what do you think about reinstating the uptick rule, 57% of the respondents said they thought it was a great idea, that it should be done. And, 3 years ago when we first started talking about this, Jim, nobody was talking about the uptick rule. But now you're starting to see it in the papers. They're talking about shorting all the time. And, on the Canadian markets, your chances are reduced. It's like reducing the odds on a slot machine. Your chances are reduced on hitting the home run, and they're magnified that you are guaranteed to lose money.
We'll have more with Larry Reaugh next on This Week in Money.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Larry Reaugh, President and CEO of American Manganese Incorporated. Canadians are very inventive people. Most probably don't know, but we invented sonar, the electron microscope, pablum, instant mashed potatoes, and as I say, most importantly, the push-up bra. But without a junior exchange that accepts money freely and lets people take their chances, we won't have those kind of inventions anymore, will we?
No, they're dying off. I mean, how do you get those ventures going when you can't even get money to raise a trial balloon on it? Basically, a company needs $5 million to develop a business plan that'll eventually give them the answer that if they can proceed with it, it's a new technology or it's a new discovery or it's a new this or a new that. And then they can finance it. But getting that initial seed money today is extremely difficult.
One of the hopeful things I heard, though, about the venture exchange is that an American high-tech company moved here from San Francisco because they thought the Canadian exchange gave them the best chance to develop, even with these tough rules. Is that the kind of attitude we need to encourage more of?
Well, you have to encourage that, but you can't throw up a roadblock by saying that, if you bring lots of buyers into the stock, you'll attract the predators, and they need that buying in order to short a stock. Without buying, they can't short a stock. A lot of the companies are boxed in on both sides by predators. I mean, they're on the bid a cent or 2 cents lower, or in some cases a half a cent lower, and they're on the offer. And that's just the arbitrage between themselves. And then, of course, when the real buyer comes in, that's when they make the real money. So, no, I mean, nothing's going to work for the long period because eventually not having an uptick rule will crush a company.
Germany outright banned shorting on their stock market. Would that be a good idea here?
I think, personally, I've heard different opinions on that. I think it would be a good idea. But, you know, the reality is something worked for 80 years. At that time, we had a buoyant market. Let's just take a look at the Toronto Stock Exchange, which is subject to the same things that the TSX Venture is, and that is that you could short. There's no uptick rule on the TSX, right? Now, if you look at statistically at what's happened, you see that other markets around the world have boomed. And the Canadian market has just sat there like it was sucked down in quicksand and raise its head and then drop back down, raise its head and drop back down. You know, I'd have to say that my interpretation of that is that somebody made a lot of money shorting Canadian stocks. I mean, we invited the world to come in here and to destroy our companies and in the process destroy our economy.
Larry, putting your CEO hat back on, the focus of American Manganese has changed. What's new?
Well, what we found was that our patented process for treating low-grade ores of manganese would work on a recycling of lithium-ion batteries, rechargeable lithium-ion batteries. I'm talking about the automobile industry, not the ones you have in your laptop, telephone, small batteries like that, because we want to focus on a brand name in order to run the program of recycling that would recycle the same material back to the battery manufacturer that they had initially had when they started the battery. So, you know, we've had third parties actually pay good money to have companies come in or not companies, but law firm. One, for example, a law firm that came in and did a due diligence on our white paper, the one that Chemetco had, initially gave us on the fact that they thought or they believed that the chemistry and the mathematics said that we should be able to reclaim lithium-ion batteries, and we got the thumbs up. They got the thumbs up on that. So we think our theory, and we're on solid ground there. We have to do a proof of concept. We can get that cost down to do the initial proof of concept, and then maybe we'll attract a lot more believers. But, we've de-risked it quite a bit by having third parties look at it, and, if we can produce a economic electrolytic metal using this process, we should be able to take the concentrated cathode material and produce and duplicate that cathode material at the tail end of our plant. American Manganese, of course, trades on the TSX Venture Exchange, and it basically has been working with technology for the last 6 or 7 years. We've developed batteries from our product out of Arizona, the lithium manganese batteries, button cells, and proven that the concept of that works. We spent millions on doing that, and also piloting the initial patent. So now we're sitting there with, of course, depressed prices in most commodities, and of course manganese is one of them. And we're looking in our own backyard, and Chemetco said, "Hey, this is what you should be focusing on." So that's what we're focusing on, and we'll keep our mining project, and we'll keep our patents for that. But what we want to do is we want to move into a very exciting field, and that's been only made more exciting by the Model X pre-orders through Tesla Motors. I mean, the last I saw, they had 325,000 pre-orders at $1,000 a piece, and that is double or more than double the amount of electric vehicles that were produced in the last 2 years, 14 and 15. So you can see that this industry is going to take off. There's going to be a lot of batteries that are going to be coming up. They're toxic. Currently, they're either going into a toxic waste dump or stored, or they're being sent to smelters to be burned, and they get back some slag and they get back some of the cobalt, and the rest of it they don't get. But we're looking at an economic solution to actually reproduce the product. And what's that do? Well, it does two things. It gives us a chance to look for a profit center. There's a couple of profit centers in there. And it also is a circular economy for us, because we're not having to dig in the earth to produce these materials, these cathode metals, and in order to make a new battery. We can take the existing metals that are in batteries and recycle them.
Larry, thanks for being on This Week in Money.
Oh, you're welcome.
My guest has been Larry Reaugh, President and CEO of American Manganese Incorporated, the website AmericanManganeseInc.com. That wraps up our show for this week. We'd like to thank our guests Ross Clark, Adam Hamilton, and Larry Reaugh, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.